Hello, everyone. Logan Hertz here with Hazeltine LLC. I have with me, as usual, Peter Nelson of Nelson Insurance Advisors. Peter, how you doing?
Living the dream, Logan. Living the dream.
So today, I thought we'd talk, or rather, Peter thought we should talk a little bit about taking out life insurance policies on children, on juveniles. This is something that I know Peter is very passionate about. A lot of people don't even think about taking out policies on their children. Um, so, Peter, why would someone want to take out life insurance policies on their children?
No, it's a wonderful question, and thank you for doing this with me because I think it's so important. So, what I what I like to always say is, you want to ensure the child's insurability. Okay, this is not about profiting off the death of a child, but what you're doing is you're locking in their insurability for, quite honestly, the rest of their life, whether it's being with one of our 50 or 60-year term strategies that we have the ability to do, or writing a cash value life insurance policy to give it the opportunity to, of course, grow over time, right? You have to, whole life works better if you once you get to the year 20, year 30, year 40. So it has nothing to do with profiting off the death of a child. I have a son, and I couldn't imagine. Actually, I would have no desire to profit off of his death. I would be probably destroyed if anything happened to him. But do I have a lot of coverage on him? I do. I believe I have right now, and I'm not happy with the amount, but I think I have 300,000 a whole life, another $150,000 fully convertible term, and my goal is over the next 6 to 8 years before he turns 18 to have $1 million of cash value life insurance on him, so that really he'll be set for the rest of his life. And so, I mean, this is something, and what I see parents actually doing is they take out these really small, and I'm sorry to say this, but rinky-dink policies, a $10,000 whole life, or to add a child rider onto their current term policy that's maybe $15,000 of coverage. They can never buy coverage any more affordable than when they're young, when they're new. I mean, newborn's the perfect age. And so, anyways, yeah. I mean, I
So there's so much there that I actually wanted to respond to. There's a lot to unpack here. Um, this falls under the category of sort of intergenerational coordination of finances, which if you read What Would the Rockefellers Do, you see the difference between the Rockefellers, who are still incredibly wealthy today, and the Carnegies, who were wealthier than the Rockefellers at one point, but within two generations of Andrew Carnegie dying, they were basically middle class again. Okay. So I don't like the fact that money is a taboo subject. Families really need to be talking about this stuff. And it doesn't take, you don't have to make any more additional money if you just coordinate what you're doing with your children, with your siblings, with your parents. It can be a much more effective plan without you having to make any more money. The analogy I like to use is, Peter, let's imagine you're the CEO of a company. You've got 12 awesome, awesome employees who are really phenomenal, but they never talk to each other and they never coordinate anything. Each of them just goes off on his own and tries to make money, and that's it. There's no coordination, right? What kind of a company would that be? Well, that is exactly how most modern American families operate. Everyone just goes off and does their own thing, and nobody coordinates. There is zero coordination, right? And especially when someone dies or gets sick, that's when all of a sudden you realize how important coordination is, right? So that's part of it. Um, Also, Ryan Griggs talks about this when you meet people and you expose them to infinite banking or to the power of whole life insurance. A lot of them will say, "Man, I wish I'd met you 20 years ago," right? Because the most important element in this whole plan is the passage of time, right? How these policies age and how they get dramatically better every year. Like a whole life policy in year 20 is unbelievable, right? As opposed to year zero, where it's just getting going. You're trying to get that locomotive going, and there's not a lot of momentum yet, right? So imagine if you could start a policy when you're an infant, right? And by the time you inherit that policy from a parent and you're like 25, you've already got 25 years of compounding, and that locomotive is in full swing, full momentum, right? Cannot be stopped. Even if you didn't pay any more premiums into that policy, which would be stupid because you absolutely want to feed that locomotive at year 25, it would still be a phenomenal policy just through the power of compound interest, the time value of money, right?
Right. Yeah.
Um, and I agree with what you said about insuring the child's insurability. That to me is the primary goal. People don't believe me when I tell them this, but Peter, it is possible something negative can happen to your health. That is possible. Right.
Correct. And we're going to talk about here in a second, or at some point during this, a case that I just ran into down in Texas with one of my agents, and I think it needs to be talked about.
Yeah, nobody believes me, but it is possible something negative could happen to your health. It is even possible something negative could happen to your health in childhood, right? And then you would not be able to get any form of life insurance, or maybe it would just be a highly rated case, so it'd be much more expensive, right? So your options become very limited, right?
Right.
So why, if you're a loving parent, why would you ever put your child's insurability at risk? Wouldn't you want to protect it at the youngest age possible? Okay. That is the primary thing. Another thing I'll say too, of course, our opponents always have to ascribe to us the most evil motives possible. So the only reason anyone might want to take out a life insurance policy on somebody else is because they want to profit from that person's death. That's the only reason it could possibly be, right? Um, Now, some of these people, I'm like, have you ever lost a child? Have you ever met a parent who has lost a child? Right? That death benefit is actually very important, believe it or not. Because when you go through something as emotionally devastating as that, it absolutely has a financial impact. Absolutely. Right.
Yeah.
People
And
who
you
have
make
been
a good
through,
point, Logan. I mean, let's just hypothetically say, and once again, I don't know how I would ever be able to recoup if I lost my son, because I have one child. It'd be devastating to me. And I don't think I'd be able to work. I mean, I'm getting a little teary eyed just thinking about it. I don't think I'd be able to work for quite a while. I mean, I would use that life insurance to, just to not work for a while, right? I mean, you don't want to, I mean, what if you have other children? Aren't your other children going to be consoling and everything? You want to be there with them, right? You don't want to have to go back to work. That is the power of this. This is what people don't think about. So,
yeah, these are people who I guess have never had any serious negative emotional things happen to them. There's always a huge financial component to it. And someone who has been through something like this, loss of a child, loss of a spouse, illness, any of these devastating things, understand there's a huge financial component. It kind of reminds me of how, a lot of marriages that end in divorce, a lot of times the catalyst is finances. It's not that finance is necessarily the cause, but that's the catalyst because that's the one thing you cannot ignore. It's in your face every day. You cannot ignore it, right? Those bills are coming due. And it's the same thing here. It's easy to say, well, there are more important things than money and I've got to just grieve and blah, blah, blah. Well, that's great. Stuff still has to be paid for. Okay. You can't ignore those finances. There is a massive financial component to this. And absolutely, when you go through the devastating emotional meat grinder of losing a child, that death benefit protection is extremely important to the family, right?
right,
You are not profiting from your child's death. You are being given a way to grieve properly. One of the things about the death benefit that DeAndre Clayton and others talk about is that it gives you time to grieve properly, right? If you don't have that death benefit protection, you got to earn income. You can't grieve. You have to go back to work real fast, right? You can't not have the income, right?
yeah, it's a peace of mind. You can say, well, it's from a financial perspective, but you could also say just it's a peace of mind to know that if the worst case thing that would probably ever happen in your life, or one of the worst things, that the peace of mind knowing that you don't have to go back to work right away. What's that worth? And that's worth a whole heck of a lot.
Right, right. One of the things you mentioned too, Peter, that I think is worth mentioning, this isn't necessarily like a long-term solution, but there is a low cost alternative where if you take out, let's say, a term policy on yourself, you can typically get a child term rider, which will give you some minimal coverage on your child, which is something, right? Basically, it would pay for the funeral if God forbid something happened to him, and it does give the child the right to convert to permanent coverage for a small amount. So it's something, right? Something's always better than nothing. But that brings up an important point too, which is we need to explain, I think, because we kind of jumped right into this. How does this fit into your overall financial structure? Because we certainly believe in parents taking out policies on their children, but it's not necessarily the place to start, right? So you want to explain that a bit, Peter?
Um, yeah, I mean, from a financial planning perspective, I think you want to incorporate it into your overall plan, right? You don't want to just do this willy-nilly. Like you kind of said about, if what happens if you're a CEO of a company and no one's talking to each other, right? So yes, we want to get them coverage, but we also want to make sure we're doing it all in what I would say a holistic approach that, the parents have the proper amount of coverage, right? First of all, let's make sure they're taken care of. Because, by the way, a lot of these juvenile policies, especially the larger ones, you're not going to be able to take it out if the parents don't have the proper amount of life insurance. Typically, you can get 50% of what the parent has. You can get that in juvenile coverage. That's just a rule of thumb. Some carriers are different. Sometimes they'll allow you to tweak it a little bit. But yeah, you really, at the beginning, that first meeting when we're doing a fact finder and finding out the overall picture, that's where you want to incorporate it, right? I mean, we haven't even mentioned yet about using cash value life insurance for the juvenile for college funding, right? Instead of using a 529. That's a totally, I wanted to mention that we didn't forget to talk about that as well, but that's another powerful tool. I've had a couple clients over the years that have funded their child's college with accessing the cash values. The cool thing about that is, of course, cash value life insurance doesn't show up on the FAFSA form for one applying for financial aid. So there's a lot of things that you want to incorporate into this overall plan, right?
Right. So the place to start is by locking in the insurability and getting the death benefit protection on the parents. So the primary bread earner and the spouse both need to be fully insured. Okay. It could be just convertible term. It doesn't have to be whole life, right? In fact, you probably will start with just convertible term, not whole life. Once you have that full death benefit protection and you've locked in the insurability of both parents, then you can talk about policies on the children. Okay. There is one good carrier that Peter and I are aware of and work with that will do convertible term policies on children, right? And so that convertible term, of course, gives you the death benefit protection on the child because it's term and because it's a child, it's very inexpensive, with importantly, the option to convert it to whole life. So you can take out a 50-year convertible term policy on your child. You've now locked in that child's insurability for 50 years, right? And you have the option to convert it. You can keep that policy yourself, convert it, use it yourself. You can transfer it to the child at some point in the future. There's all kinds of options, right? You can split it into multiple policies when you convert because you don't have to convert it all at once.
Right.
So many options. Now, all your options are on the table. If it turns out that, let's say, both parents are not insurable, then you can actually take out policies on your children without covering yourself first, but only if both parents are not insurable. And of course, that wouldn't be a good thing. You always want to cover yourself first, and the insurance companies require it for obvious reasons, right? The life insurance policy on your child is a great thing, but it doesn't protect the child if you, the parent, die. So you always want to start with yourself, right?
Right.
So
Absolutely.
get the death benefit protection and protect the insurability of the parents first, then start doing the same for the children, right? And I've seen, you know, children get declined. I have
Yeah.
a client. We applied for a policy on his daughter, who's I think less than 5 years old. She was declined. She had some developmental issues, right? She may be insurable at some point in the future. It's not clear, but she was declined, right?
Yeah.
So you want to do this as soon as possible. Um, Now, when the child is eligible depends on the company. Typically, it's something like 15 or 30 days after birth, something like that, when the child is eligible. But you want to get that policy on them as soon as possible,
Yeah.
right?
And Logan, let me just mention, because I think this is a good place to mention this case we ran into in Texas. child was born February of no, December of 2022. So preferably by January of 2022, we would have gotten the coverage on him. Of course, we didn't know the client at the time. They're, the family. Recently they came to us. The child was diagnosed in February of 2024, so less than 2 years old, with type 1 diabetes. We sent that out to 12 companies, and pretty much everyone gave a decline. Outside of one of our fraternal companies offered a small $15,000 whole life policy. Now, the good thing is if the type 1 diabetes stays under control, probably at age 7 to 10, depending on the carrier, we can apply for coverage and probably get them some coverage, but it will not be probably a standard rate, most likely. Okay. So once again, this is just where you mentioned you want the best time to apply a newborn. Let's just say hypothetically, after 1 month, could be sooner, could be a little bit later, but at 1 month, you get that child, you get some coverage in force because you do not know what's going to happen. I cannot stress this enough. This case, I've been talking about this for years, and here it is again. It just kills me.
Life insurance is not a need product. It is a love product. How much do you love your children? Do you want to protect their insurability or not? Right? How much do you love your children? Ryan Griggs, a big infinite banking guy, he talks about this, about how, again, when we talk with clients, we always get that, oh man, I wish I'd known about this 10 years ago, 20 years ago, 30 years ago, right? Depending on the client's age. And Ryan's response is, look, we're all catching up. Every single one of us should have inherited policies from our parents. All of us should have had policies taken out on us when we were born. And we should have inherited policies from our parents. That's the way it should work.
No, I didn't. I don't know about you. I didn't inherit any policies. Did you?
No. And again, it does happen. People don't believe me when I say this, but it does happen that you can lose your insurability, or your insurability could be impaired for a host of reasons, right? Something happens to you, something happens to a family member, right? It could be any number of things. Okay. And then you're permanently locked out and you can't get access to infinite banking, whole life insurance, all the wonderful things that life insurance can do for you, right? Which is not just death benefit protection. There's so much more to it than that, right?
Yeah. And I'll just mention too, I mean, this is a good segue into, and okay, let's say we're not doing term, we're talking about locking in the rates forever with a whole life policy, right? This is where I'm not against, by the way, especially if it's a really good whole life that's very flexible. I am not against writing a base whole life policy. Now, if the parents have cash available and they want to do a more max funded policy, that's amazing. But one of our companies, for example, I was just talking to the vice president about this. He's like, Pete, you can rate these children a large base whole life policy, and then later on, because our whole life is so flexible, you can just dump in a ton of cash later on. And I'm like, oh my God. I was kind of thinking the same thing, and I've even been playing around with universal life policies the same way. But with the whole life, of course, you have those contractual guarantees where now some whole life policies aren't going to allow you to do that, right? But if you got the right one, my gosh, is that powerful.
Yep, I have a client who's done that, where we take out, these actually are not all base policies, but policies where he's paying just the base, while he gets it going, and then he'll put in more later. So yeah, again, the number one most important element in a whole life policy is the passage of time. These policies age like a fine wine. So if you take out a policy on a newborn, it could be the worst constructed policy in the world. It's going to perform really well because it's going to be enforced for so long. Just think about a compound interest curve, right? The longer it's enforced, the more powerful it gets. So yeah, policies on juveniles, whole life policies on juveniles are phenomenal. Obviously, the mortality costs are very low, and they age so well. Now, again, it's not the place to start. Believe it or not, a policy on an adult will actually perform better from a cash value standpoint than a policy on a child.
Right.
At least for the first probably 20 years. And the reason is because what is cash value? Well, cash value is the net present value of that future death benefit. Okay. So because the child is further away from their natural mortality, they actually have less cash value early on. Now, eventually that policy will exceed the performance of an adult's policy because the mortality costs are so low, but most importantly, because it's just going to be enforced for so much longer, right? So these are phenomenal policies, but I just want to make sure we're clear that it's not the place to start. You start with a policy on yourself first. Get yourself and your spouse fully insured first. Then we can talk about policies on the children, right? But
Right.
again, to Peter's point, because these policies are going to be enforced for so long, case design, I mean, it's still important, but it's going to look good. It's because of how long it's going to be enforced, right? They're going to perform well.
Right. Now, one thing I want to mention too is when I'm sitting down, I always ask, of course, do you have any grandchildren to, my clients? And then I throw a joke in and I say, you probably don't love your children anymore, just jokingly, of course. But I say, I bet you love the heck out of those grandkids, don't you? And they're like, yeah, right. So this is really what I want to. Grandparents, if you're listening, anyone has any grandchildren, it doesn't mean that the parent has to purchase the policy. You can, I can't tell you how many cases or policies I have enforced where the grandparents have done really well. They want to build this multi-generational wealth. They're the owner, they're the payor, they're the beneficiary, and then of course the child would be the insured, right? Or the grandchild would be the insured. So powerful. So grandparents out there, instead of maybe buying them as many toys coming up for Christmas, really build them something that later on it could potentially make them, hundreds of thousands, if not millions of dollars. My gosh. Now think about that, it's in the Rockefeller book, right, Logan, where John D. Rockefeller still is leaving gifts, after his death. How long ago? That your grandchild or child is probably not going to remember that toy you got them. But if they got this policy worth hundreds of thousands or millions of dollars, they're probably going to remember your name, right?
Yep. And this is where the use of a trust becomes important to make sure that those assets are not squandered, right? That's part of it as well. So you'll use whole life insurance. You'll probably also use a trust because it's a good thing to leave millions of dollars in legacy and this great cash flowing asset, but you want to make sure that that money is used responsibly. And that part of intergenerational legacy planning is what we're talking about here, meaning setting it up. But also the other most important part is just the communication, talking to your children, talking to your grandchildren, talking to your siblings, talking to your parents, talking to your grandparents about this and making sure that we have a plan that spans multiple generations and includes all of the family members. And if you do that, man, your financial life gets so much more powerful and so much more peaceful, right? Because you know that all of these unfortunate negative events that do happen are accounted for, negative health events, death, right? Illness, right? All these things. So, yeah, I'll put in a link in the description to What Would the Rockefellers Do. That is a book that everybody should read relevant
Yeah,
to
I'm
this.
trying to see if I have it.
Yeah, but you should read that book. So,
Yes.
Peter, is there anything else you want to say in closing
Oh, I got
about?
it here. Hold on. I'll just show up with a quick picture. I knew I had it here. What would Rockefellers do right there? So if anybody's, I know you're going to put the link, but that's what the book looks like. So,
So Peter, anything you want to say in closing about taking out juvenile policies?
if you have any children or grandchildren and you have the means to do it, please do it now. There's no better time to do it. I just cannot tell you how passionate I am about this. And I think with all this volatility and craziness going on in this country and in the world right now, get it going now. Like you said, you gotta let these policies age and just let them do their thing. And it's amazing. It really is.
All right. Thanks so much for your time, Peter. We'll look forward to the next one.
All right. Thank you, Logan. God bless. Godspeed.